Hey everyone, and welcome to This Explainer. Today, we are tackling one of the absolute most fiercely debated questions in modern finance. Is Bitcoin a true hedge against inflation, or is it literally just a highly volatile speculative asset? Listen, inflation isn't just some boring macroeconomic buzzword. It's the silent erosion of your everyday purchasing power. It is the steady decline in what your hard-earned money can actually buy over time. Finding a real shield against that erosion, that's absolutely crucial. For years, this whole debate has been dominated by opinions, narrative bias, and endless social media hype. But today, we are stripping all of that away. We're going to look strictly at the hard, peer-reviewed data from a totally fascinating academic study published in Economics Letters. We're going to see exactly what happens when economists put Bitcoin through rigorous time series analysis to find out how it actually interacts with inflation expectations. Get ready, because the data reveals a story that might just surprise you. Okay. Let's dive into this. We are going to systematically break this down step by step. First, the great Bitcoin debate. Second, defining an inflation hedge. Third, the time series test. Fourth, surprising academic findings. And finally, implications for investors.
Section 1. The Great Bitcoin Debate.
All right, to really understand the origins of this study, we got to travel back to the wild, volatile economic environment of 2020 and 2021. You remember it. The pandemic hits, right? Central banks all over the world just enact these massive expansionary monetary policies. They were pumping unprecedented liquidity into the markets just to keep economies from completely collapsing. But with all that newly printed money came a very real fear of soaring inflation. And in the middle of all this intense macroeconomic uncertainty, Bitcoin steps into the spotlight in a massive way. Its market capitalization actually eclipsed the $1 trillion mark. Its sheer size meant it literally could not be ignored anymore. Institutional investors, multinational corporations, top-tier economists, they were suddenly forced to take it seriously. This wasn't just some quirky internet experiment anymore. It was a macroeconomic force fueled by an absolutely unprecedented influx of global liquidity. The psychology of the market shifted so fast during this phase. Investors were genuinely terrified of their fiat currency losing value, and they started frantically searching for a risk-off safety net. This is where the whole digital gold narrative truly took hold. You had billionaire hedge fund managers like Paul Tudor Jones buying Bitcoin as a direct response to central bank money printing. And then companies like MicroStrategy went in and purchased roughly 20,000 coins in early 2021. They explicitly stated they believed Bitcoin to be a dependable store of value. So, in the minds of these early buyers, Bitcoin was literally digital armor against the weakening US dollar. But we have to impartially balance this debate, because the skeptics were just as loud, and they happened to hold some of the highest offices in global finance. There was this tremendous psychological tension in the markets. Was Bitcoin a true structural hedge, or just an unproven risk asset riding a temporary wave of excess liquidity? In March 2021, Federal Reserve Chairman Jerome Powell pushed back hard. He flat out stated that cryptocurrencies are highly volatile and therefore not really useful stores of value. He categorized Bitcoin as a purely speculative asset, kind of saying, hey, maybe it's a substitute for gold, but it is definitely not a reliable alternative to the dollar. So the dividing lines were drawn. It was the billionaires versus the central bankers. Section 2, defining an inflation hedge. Now, what's really interesting here is the fundamental structural difference between these two assets. We have to understand what exactly makes something an inflation hedge in the eyes of an economist. The classic economic definition of a hedge is an asset whose returns are independent of or positively correlated with the rate of inflation. Think about how inflation actually affects you. When central banks print more fiat currency in endless supply, every single dollar you hold loses a tiny fraction of its value. So why do people think Bitcoin fixes this? Simply put, Bitcoin has a hard mathematical cap. There will never be more than 21 million coins, ever, period. It operates on a decentralized system that is totally immune to central bank expansionary policy. That limited, unchangeable supply gives it the theoretical potential to protect against rising prices. But, as we all know, theory is one thing, hard data is another.
Section 3. The time series test.
So, 3 researchers, Benjamin Blau, Todd Griffith, and Ryan Whitby, decided to bypass all the social media rhetoric and just look directly at the data. They published a study in Economics Letters using a very specific daily data window, January 1, 2019 to December 31, 2020. Now, this timeline is absolutely crucial. It brilliantly captures 2 totally distinct liquidity conditions. It includes the relatively normal, stable, low inflation pre-COVID market behaviors of 2019, as well as the extreme, high-stress post-COVID environment of 2020, where monetary policy rapidly expanded. By looking at daily prices over this 2-year span, they had a really robust set of data points to objectively analyze how Bitcoin behaved under very different macroeconomic pressures. But what exactly were they comparing Bitcoin's price to? They used a macroeconomic metric called the 5-year forward inflation expectation rate, or the T5IFR for short. This data comes straight from the St. Louis Federal Reserve. Now, the math behind it involves calculating the yield spread between standard treasury bonds and inflation-protected securities. But listen, you don't need to be a math whiz to understand it. Simply put, this metric represents the traditional market's collective financial bet on what inflation is going to be in the future. It is the ultimate expectation indicator. Here was their exact methodology. Step 1, they tracked the daily percentage changes in Bitcoin prices. Step 2, they tracked the daily changes in that St. Louis Fed inflation expectation data. Step 3, they estimated a vector autoregressive, or VAR model. A VAR model is just a statistical tool economists use to capture the linear interdependencies among multiple time series. Basically, they weren't just looking for some simple correlation. They were specifically looking for a structural lead-lag relationship. The big question was, does Bitcoin move first, or do inflation expectations move first? Section 4, surprising academic findings. Okay, to really understand the researchers' striking results, we first have to understand a concept called Granger causality. Now, don't let the word causality confuse you. It doesn't mean that one thing physically forces another thing to happen. A great analogy here is a weather vane on top of a barn. A weather vane obviously doesn't cause the wind to blow, right? But it consistently moves before the weather hits, making it a highly accurate predictor of the wind's direction. In statistics, if variable x Granger causes variable y, it simply means that past values of x contain information that actually helps predict y. X is the weather vane. So the crucial point is this. The study found that changes in the price of Bitcoin Granger caused changes in the forward inflation rate. However, the opposite is not true. Inflation expectations do not Granger cause changes in Bitcoin. Bitcoin is the weather vane here. It is acting as a leading indicator. The data shows that the Bitcoin market is literally sniffing out and reacting to inflation expectations, front-running the traditional markets before those fears are fully priced into the St. Louis Fed's official metric. Pretty wild, right? The researchers actually took it a step further. They mathematically imposed an exogenous shock to Bitcoin, basically simulating a sudden, unexpected jump in Bitcoin's price within their model. When Bitcoin spiked, it resulted in a significant and persistent increase in the forward inflation rate shortly after. What this means for risk management is huge. An unexpected jump in Bitcoin's price often acts as an early warning siren that the broader market is about to price in higher inflation. You shouldn't just trade macro headlines alone. You need to look at this market structure. And critically, this wasn't just some fluke caused by pandemic chaos. This lead-lag relationship proved incredibly robust across both the stable pre-COVID period and the highly volatile post-COVID period. Section 5. Implications for investors. Let's see how this translates into real-world strategy, because the primary takeaway is right here. The academic data provides concrete economic support for the idea that Bitcoin can serve as a viable hedge against expected inflation. Remember earlier we said an inflation hedge is supposed to positively correlate with rising prices? Well, this study proves Bitcoin's returns are not only positively correlated with future inflation expectations, but they actively lead them. Think back to the psychology of those early institutional buyers we discussed. This data objectively validates their macroeconomic thesis. It shows why staying objective and looking at the structure, rather than just getting caught up in narrative bias, is so important. We've seen the debate, we've defined the terms, and we've walked through a rigorous peer-reviewed time series analysis showing Bitcoin acting as a leading indicator for inflation expectations. But look, the markets are unbelievably complex, and human psychology and narrative bias are always going to play a role alongside the hard econometrics. Sometimes Bitcoin rises as a hedge, and sometimes it faces risk-off pressure depending on those deeper liquidity conditions. So I leave you with this final thought to ponder. Based on the academic data we just explored, combined with what you are seeing in the markets today, do you believe Bitcoin has proven itself as a true structural shield against inflation, or do you think it remains just a highly volatile risk-on asset? Let us know what you think. Thank you so much for joining me on this explainer. Keep learning, stay objective out there, and I'll catch you next time.